Hello, and welcome to a liaison meeting between the Governmental Accounting Standards Board and the AICPA State and Local Government Expert Panel. It is great to see everybody. It's great to have you here. As a reminder, this is a public meeting. It is being broadcast out. People can only hear you when you turn your microphone on, so please remember to, when you're speaking, turn the microphone on, which is hit the little button there that turns green. You see the green ring around the top. But when you hit it, give it a little pause before you start talking. The camera will kind of come to you. And so just take a breath and then start speaking once you hit the microphone. I appreciate you guys being here, having served on the expert panel a number of years ago. I know what you're doing to help the profession, and we really appreciate your volunteering your time for the AICPA, helping the profession. And as part of that, and in addition to that, you're volunteering your time to help us at the GASB, whether it's responding to comments or responding to exposure drafts or due process documents with your comment letters, or just bringing practice issues to us and telling us what's going on, telling us the challenges you're facing, helping us know how we can help. So we really appreciate the feedback you give us and the input you give us, including at meetings like today. So we're excited to hear about the practice issues you guys are experiencing and give you an update on where we are with some of the projects and get some feedback from you guys and give us an opportunity to chat and talk to each other. So with that, Tony, I'll turn it over to you, but welcome.
Thank you, Joel. Again, I want to reiterate our appreciation for allowing the State and Local Government Expert Panel to visit your offices and meet with you. I think this is extremely valuable and a benefit of being on the expert panel to have this access to the board and to the staff. Extremely invaluable for us and hopefully, as you said, for you as well. Like I said, we're going to do some introductions. I'm Tony Boris. I'm a partner with Crow and I represent a chair of the expert panel. Jeff.
Thanks, Tony. I'm Jeff Markert. I'm a partner with KPMG in our national office.
Marla Hummel. I'm a partner with Grant Thornton out on the West Coast in Los Angeles.
Scott Reeser, GASB staff.
Joe Wicklund, GASB staff.
Diane Ray, GASB member.
Brian Caputo, GASB member.
Pam Dolan, GASB staff.
Paulina Otto, GASB staff.
Jeff Praviti, GASB vice chair.
Tammy Waymeyer, GASB staff.
Tracy Cooley with Deloitte.
Tim Lyons with Malden & Jenkins.
Amy Sutherland, director with Moss Adams out of Seattle.
Tina Stewart with Carr, Riggs & Ingram.
Joel Black, GASB chair.
Alan Skelton, director of research technical activities.
Michelle Cherkasky, GASB staff, and I serve as the staff liaison for the AICPA groups.
Kim Williams, controller for the District of Columbia.
Jody Dobson with Baker Tilly.
Chris Salem, I'm a director with PwC in their national office.
Susan Wheeler, I'm a partner with EY.
Chris Knight, GASB board member.
John Su, GASB staff.
Deborah Beams, GASB staff.
Carolyn Smith, GASB board member.
Jackie Reck, GASB member.
Chris Telly, I'm a partner with Forvis.
Kristen Schote with Robinson Farmer Cox in Virginia.
Bill Blend, MSL, Florida.
Sarah Timmons, AICPA, and staff liaison for the expert panel.
And I'm Mary Folster, AICPA Senior Director of Governmental Auditing and Accounting. So I'd like to also add my thanks for you all hosting us, having dinner with us last night, and for the ongoing relationship that we've had with the board for the years. So thank you. I think, Tony, I'm going to give it back to you to start the practice issues.
Thank you, Mary. As Joel mentioned, one of the topics or one of the areas we like to cover in this liaison meeting is just practice issues of what we're seeing just based on something in the environment, but also just pertaining to maybe some recent standards that are applicable or going effective or being implemented. Just things we're seeing with maybe that we didn't notice before, and now we are and encountering them as they go live. So the first practice issue we wanted to discuss is related to the Inflation Reduction Act of 2022, and specifically to the investment tax and production tax credits that are being offered through that program. Based on the elective pay or the direct pay option, we are seeing some state and local governments take advantage of these credits. While many of our clients have not started the process, some have, and they have started questioning and asking some questions pertaining to recognition and so forth pertaining to those. It is still early in the process. We're not seeing many of those projects culminate with receiving the cash, but we are anticipating some confusion potentially on the recognition of those funds when they are coming in, just based on the whole process of a tax credit, which could be foreign to a state and local government who doesn't usually submit tax returns or deal with anything from the IRS. So based on incurring the eligible expenses, to registering with the IRS, to submitting a tax form, and then obviously ultimately receiving that cash, there could be different points in that process that in a government's mind could trigger what they think should be the proper recognition. So at this point, we're a little confused because each government could treat it differently. And we anticipate that there won't be a universal answer to the process because there are different credits involved, and each credit could vary based on the government who is utilizing them. So at this point, we just want to bring this up because we are monitoring it. We are starting to see questions come in, and we would just like to, ask staff or the board if there have been any considerations to this topic and potentially revenue recognition type guidance or anything they would like to provide related to these credits.
Thank you. So I think I can tell you a couple of things of what we have thought in explore research and the things that we know, maybe a few things that we still, excuse me, don't know yet. So from a type of transaction perspective, the very first few conversations were about, are these environmental credits or this fall under the Statement 33 non-exchange model? I think I got a lot of consensus on the 33 model, so we're comfortable in the voluntary non-exchange transaction type. So that gets you down the path of eligibility requirements. You have 4 eligibility requirements, being the government path. Let's park time requirements for a moment. I noted you mentioned qualifying requirements, expenditures. We didn't interpret the program with expenditure-driven grants, but rather with a contingency, which is completing the project. You don't have a claim to the resources as you build the solar farm or the wind farm or those sort of things. The program looks very much to the point where you have completed whatever activity is that you have to do. So it looked like a contingency requirement of completion of a project, of acquisition of a solar farm or a panel or whatever installation you're doing. And so that's where we have been navigating. We have got a few questions at the beginning of is this expenditure driven and can I book a receivable, expend the costs? We have not got comfortable with that conclusion based on the program requirements. And then you go down to, okay, so the completion of the project, you still have a few potential points, and those are a little bit more of the unknowns in our perspective. You have to register your project once you complete it. Does the registration mean anything? The answer that we have gotten is that it's an internal control issue. So the IRS wants to know so they can put you in a list of no duplication, no fraud, no things, but it didn't sound like they're really committing resources for you. And then there's the whole nuance of governments generally don't file tax returns and they have to file a 990 and then wait for the approval and application and response. So that's where the ambiguity starts coming from. And we're still trying to think about how to respond to that part of the receivable, but we don't believe it would happen until any point after the completion of the project. Any questions?
It seems like it's a challenge to provide any specific guidance due to the variation of the different programs that are potentially out there. I see that challenge. I do.
Thank you. So there's at least a program that we were being focused on study is the IRA. And I am aware that there's several other programs. I think there was one, I'm going to butcher the name, IGA or one of those. So there's a lot of variability in the programs. And even with the IRA credit, there's multiple types of programs and grants that you can qualify and then you can combine. And There's some like a base of 6% reimbursement all the way to 50, 60, 80. And so there is a variability of requirements that you would need to assess based on the project that is functioning and how are they attempted to fund the program, because some of the projects may be only eligible for 6% and may have some type of requirements. Others may combine multiple tiers and get to another place and you can get a different, slightly different conclusion. So there is a lot of complexity in terms of even within just the IRA program that you can have some variability that you need to think through.
And I know you and I have talked about this a little bit in terms of the GASB literature. You have a pretty sound framework to evaluate this, you know, in terms of 33. But I think the question we were talking about, Tony, is there a way to put a simple Q&A out there to point the preparers to the literature that this might fall under, right? Like, so some sort of Q&A that talks about the IRA program in general, that, you know, likely you would evaluate it as a non-exchange, you know, voluntary non-exchange transaction and follow the criteria in 33 without getting really specific to all the details. I don't know
So
if that
you would
helps the
envision
problem.
something that the answer would look like this program is a voluntary non-exchange transaction subject to eligibility requirements, and recognition should be done when you comply with all eligible requirements, and just leave you to figure out what that means. I mean, sort of 33 already does that.
I know. Tony, any thoughts?
Well, I think we have some confusion that folks don't get pointed to the GASB 33 because it is a credit. So they search for credit guidance or some sort of guidance in the GASB, which they're not going to find, and their mind doesn't automatically go.
There is one, and that's what I had to specify. There's a Z51, and I'm going to butcher the name, but there is one for credits. And so what I have had to explain is that is not what you would find. You will find under 33 with voluntary non-exchange. So I have had that question. Yes.
Any other questions or comments related to the topic? Thank you, Paulina. Appreciate that update. I'm going to hand it over to Amy for our next topic.
Yeah, thank you. We just wanted to briefly kind of share our thoughts on what we're seeing as a lot of our governmental entity clients are starting to really dive into and implement the compensated absences standard. I think generally what we're finding is there is a very sort of mixed level of the amount of effort that's going to need to be put into implementing the standard. On the one end, for many clients, they really aren't going to see much of a significant change, primarily because either they've adopted different leave policies that they're already fully accruing liabilities for, or just the very limited changes that were made in the standard just don't have a significant impact. But on the other end, we are seeing some clients that have much more traditional sick leave policies. This is going to have much more of a significant impact to them. And generally, the concerns that we're hearing from them more around their own internal policies and the ability to accumulate the right information to do the assessment. So do they have the ability to pull down reports to really understand what their usage of leave policies are? And I also would say, given ongoing constraints with staffing and financing, there are some that are also sort of taking that position of, well, our leave isn't very material today. We don't maybe think it's going to be very material if we fully adopt the requirements. And so I think that is some of the concern we're just feeling is some considerations might be made or decisions made around that materiality assessment in order to sort of minimize the amount of work. But overall, we haven't received really a lot of significant concerns, just really more the time and effort going into really making sure that they have the right information to make those assessments. But interested if you've heard any questions or if there's been any other concerns or potential clarifications that need to be made.
Yeah, thank you for that. We have not heard all that much on this one yet. Some of that's a function of timing, as we're not quite to the end of the year for the first year of adoption for calendar year entities. And then we've got the calendar year entities are the ones adopting first for this particular standard. But there's also probably some of that materiality aspect that, for a number of governments, this isn't going to be material, and so it's not going to be a big deal, and so we're maybe won't hear as much from them. I'd say there's probably three kind of things from what we have been hearing to talk about. One is that, yes, for a lot of governments, the sick leave is going to be the biggest change, especially if they had policies where they do not pay out sick leave at termination. Therefore, they never had to recognize the liability for that before. Now they have to consider how much of that sick leave is more likely than not to be used at some point during the course of employment. And so that will be the biggest change for them. Employment policies are a really big part of knowing how to apply the standard. And one thing we've learned is there are a lot of different employment policies out there, different ways that governments handle different types of leave, policies on paying out at termination, things like that. And so understanding what the policy is and then how to apply the standard based on that policy is going to be very important. And the last one is an issue that there seems to be maybe some misunderstanding of a certain paragraph wording related to the pay rate that's used for measuring the liability. Generally, the requirement is to use the employee's pay rate at the financial reporting date. There is an exception in paragraph 17 that if the payment is more likely than not to be paid at something other than the employee's pay rate at the time the payment is made, then you use that something other as of the financial statement date. Some people are reading that to mean, well, if this person is going to get a raise next year, it's going to be paid out at something different than their rate today. We're going to use the raise rate. That's not what the paragraph or what the requirement means. If it's going to be paid out at 50% of the employee's pay rate in the future, then use 50% of the pay rate today. And that's the example that's provided in that paragraph. We do think that with the discussion and the basis for conclusions about pay rate, people should be able to get there, but what we're hearing is some people are misreading that paragraph and trying to use a projected future pay rate.
That's interesting because that did not come up in our discussion. So I would say at least this panel doesn't feel like that is a confusing item. But yeah, I agree with your comments. I think we will certainly see more to come over the next year as different entities start to adopt this. And generally, I mean, I don't think from the panel's perspective, we see this as being overly difficult. It's just more for those that do have a significant impact, just the time and effort that they'll need to put into it, and potentially just dealing with the materiality considerations. You could certainly decide to maybe shortcut this by just saying, well, we're going to accrue everything because it's really easy to know what the leave number is. It's really easy to know what the pay rate number is. Just accrue it all. And so I think those are just our concerns, is making sure that those conversations and that people are taking the right approach. But thank you.
Thank you, Amy and Deborah. Appreciate it. Any questions or other observations pertaining to that topic? So moving on, I guess, backwards chronologically, our next topic is on GASB Statement 100 and accounting changes and error corrections. Just an observation we're seeing or trying to visualize here pertaining to changes to or within the reporting entity, and specifically when there's a change in major fund to non-major fund or vice versa. We do acknowledge this doesn't happen at all governments, doesn't happen every year consistently for governments, but there are quite a few that have this change between major and non-major funds. And we're trying to kind of accommodate or comply with the display requirements, and I think it's paragraph 31, of showing this change at the bottom of the flow statement. We're kind of scratching our heads as trying to see how this would work. And then when we put it on paper, what ends up happening, bear with me as you try to visualize this. You have a fund that was formerly major, and now in order to have that reconciliation, that kind of roll forward at the bottom of the flow statement, you have to present the beginning fund balance or fund net position for that fund, and then show that being adjusted over to the non-major column, right? So most of that column is I wouldn't say zeroed out, it's just blank, and all you're really showing is that beginning balance and then that adjustment or movement to the non-major column. But you're still displaying a fund with a title at the top, let's say grants fund or a TIF fund. That's typically seen in the major fund type of area of the financial statements. And then the reciprocal of that is if the client or the entity is presenting combining non-major funds in the SI, supplementary information, you'll have that same fund with all the current year information, beginning balance of zero, the adjustment, and so forth, and vice versa. If a fund would go major or non-major to major, it go the other way. So we see where we're presenting two fund or the same fund twice. One kind of mostly empty, ghost. We're calling it a ghost column with just the beginning balance, and then the actual current year activity being presented in a different area of the financial statement. So just trying to visualize this on fund level financial statements, which can be overwhelming to many people who aren't familiar with governmental fund financial statements, has kind of caused us to pause and step back and see what additional confusion there could be just from a user standpoint. And then thinking about it from an auditor standpoint, as you might know, our audit reports typically reference what we call our opinion units or your reporting units. And the terminology we typically use is we are opining on, let's say, governmental activities, business type activities, and each major fund. We keep it at that kind of high category side rather than identifying each major fund specifically. And the way I have always approached it is I flip to the basic financial statements and I could see my major fund columns and know which major funds we're opining on. So I think we're just kind of trying to think through the process for observation. Is that causing confusion on what we as auditors are really going to be opining on if there's this ghost column, this fund here that's not major in the current year, but was in the prior year, and if that's going to cause some confusion either in our auditing standard approach, our wording, the way we actually have to establish our materiality levels and so forth. And I guess we didn't really consider that as much until we were seeing it out on the financial statements as we go. So.
Tony, I appreciate that. And I will maybe defer to our chair, who is a former auditor on the audit side of that answer, because I'm probably not the right person to answer that. But I will say that you're picking up on, and you've already gotten to what the answer is. You do end up with a column that has no activity in it for the current year. You just have the adjustment. That was intentional. That's what we told the board. When we did 100, we talked about that specific situation and exactly how it's going to result. And the answer is yes. The questions we're getting is people not connecting the dot that they'll have that column. And so a lot of times we're having to explain to them that yes, you'll have that column and you'll have it exactly the way you just said. That with your prior balance and your adjustment and your ending balance of zero, and then you'll see the activity in what now is a non-major column. So the questions we're getting is that what happens? And the answer is yes. So I'm glad you're there. It sounds like most folks in this room are already there. From an audit standpoint, that's not probably something I could even pretend to answer to.
Appreciate that. Any other comments or follow-up questions?
Well, just to add on, I think that adds some confusion to the users of the financial statements, especially when we have some clients that put a label over those and call them major funds, right? And so then it just adds confusion to what it is. I understand it is what it is at this point, just I guess trying to say the obvious.
I think because there wasn't an illustration or there isn't a set parameter of how to label those column headings, I think there's going to be some variations and inconsistency of some governments maybe having a major fund kind of subtitle over all those columns or no title at all or formally major. There could be various options, and I think that could kind of vary across some governments.
In a way, that confusion is caused by us trying to alleviate confusion that users have when a balance that they saw in last year's report doesn't equal the beginning balance of this year's report. We're trying to take away that confusion, and it just added a different kind of confusion potentially.
Have you all been getting questions about how to title that? Like we were talking yesterday, could someone just say adjustment? I mean, they were coming up, our group was coming up with all sorts of different captions that you could put over that heading. Have you all been giving any advice on how, is there any kind of best practice on that? I see Michelle.
Yeah, I actually, I think we have been getting some questions on that. I mean, not a ton, but a few. And I do think in terms of affirmatively stating, ideas about how you might label it, I do think the one that I have heard some discussion about here internally was using the formerly major titling, and a little bit of trepidation about that because, for example, the beginning balance that's presented is not formerly major. It was major as as the beginning balance, which was the ending balance from the prior year. So that actually was a component of the fund when it was major. So I think that's the wording that we've had a little bit of internal discussion about. At least Ellen might be aware of some others, but I haven't heard any kind of ideas of being floated about exactly what to title that, if anything different from in the past.
But if you take that position that formally major isn't appropriate, then the question is, are you expecting the auditor to be opining on that as something, as a separate opinion unit? And we're assuming that not. The answer is no, but then that introduces that problem if we're not willing to say formally major.
The scenario Michelle just spoke to is the thing that we've heard probably come up the most. I think some of the individual conversations have been I'm not sure at this point we would say we'd take a formal position on that or not, because part of it's I'm not sure we say this is what your major fund needs to be titled. I just need the column and I need the information and I need the amounts. And so I don't know that we would go. I don't think we would go there, but I do know that I do know there are entities talking about that scenario. What I've probably heard is either which is probably what I intuitively would have on a personal level, probably titled it exactly the way it was in the prior year. I have not heard about. I hadn't thought about the audit consequence of that. But the other scenario we hear the most is Michelle's scenario. I haven't heard a third scenario. It's either one of those two. It's exactly the way it was last year. Just kind of the way we've thought about it, or this former scenario. And it's really just putting former above the old fund title. So the major fund is still titled the way the major fund was titled. It has in that scenario the word former above it.
Thank you. Any other comments or questions?
Yeah, I think an issue from an audit perspective would come up when you have a change in auditor, where in the prior it was audited prior year by one firm and now it's gone to non-major or vice versa, and the responsibility you might have to take associated with that. So that's the only alleviation or angst that I would have as it relates to dealing with that column. If you audit it in the prior year, it seems to me you're really just looking at the one number there, which you should have audited. But the other thing was in these smaller governments where you only have, say, you have a general fund and maybe one special revenue fund. I thought it was interesting you'd end up with these two columns essentially in the prior year being major and then non-major, and you can't simply, identify it differently from my understanding, correct?
Thank you. Anything else? Well, I appreciate the feedback to them. For our next topic, I can turn it over to Mary.
This is really more of an informational awareness type topic. I just wanted to let you all know, first of all, I'm sure you've been hearing about the pipeline issues that the general profession has been ongoing for the last however many years now. And the AICPA established National Pipeline Advisory Group, which is a large group that's been studying the broad profession issues, has just issued a draft of their final report. It's if you Google it, you can find it, and it is asking for folks to think about commenting on the draft before they issue the final version. So that report is talking about broad profession issues. So, for example, the time and cost of education, the culture at firms, all of those broader topics. But over the last couple of years, I'm sure you all have probably seen some of the articles that have been out about the public sector in particular and the dearth of CPAs that are available to work both for the governments and then also governments not being able to find auditors. And that has been exacerbated over the last few years because of the COVID-19 epidemic and federal funding coming in and people needing more audits. So the AICPA, kind of as an offshoot of that NPAG project, decided to take on a study about what specifically is going on in the public sector related to this that might be different than the broader issues that they're studying at the NPAG level. So we took on a working group that we're co-sponsoring this with NASACT. So we had state controller, state treasurer, state auditor, various size CPA firms. You all might know Michelle Waterworth, who used to chair our expert panel, is actually co-chairing this effort. And so we met with that group. We kind of brainstormed what we all thought some of the issues were. We actually worked with some of the other associations to get some discussion forums together to further kind of inform us. And the ultimate outcome of all of that was a survey instrument that we sent out, again, with the help of the other associations, as well as all the state CPA societies around the country. We ended up getting about just over 900 responses. About 50% of those were from government folks and 50% were from firms and all different size organizations. So we have the results all, we've been working on summarizing all the results. I don't really want to get into the details here because we'll be releasing the report in July. I hope when there's two organizations involved now, we have two governing structures that we have to run it through. But I mean, I guess the one observation that we have really noticed that may be different than what we see in the private sector is that there just seemed to be a general theme from a lot of the responses that the CPA and also just in general, the finance functions at governmental entities is not highly valued by or maybe understood by legislative bodies and the government officials within those organizations. And so that, we'll talk about a lot of, I would say that particular issue is probably the reason we hear about a lot of the other problems that will come out in the report, what we heard from folks. So we're hoping again that this report will include recommendations to address some of the things we heard, and we hope to get it out, like I say, in the summer. But it's been an interesting process, and we really appreciate all the feedback we've received, and I hope it's useful, both to the governments themselves and also the CPA firms that serve those entities. So anyway, it's really just something I wanted to share. I'm sure you all are hearing about it too. From your constituents. It's a big issue in government right now. And like I say, the federal funding and the need for single audits has made it even more challenging. So that's it.
Mary, I appreciate that. It's interesting because when we do a lot of GASB updates, I tend to ask a couple of questions at the very beginning, just to level set. And one of them is, anyone in this room have all the resources they need to do their job? Needless to say, nobody ever puts their hand up. So I think it's an extremely common theme that we hear every time we go do speeches, that people are resource constrained, and it's not just the governments, it's actually the firms as well, and they're resource constrained. And I try to explain to people it's not just the government space, it's also the private sector space too. But I think it's exacerbated a little bit here because there's less left for us for the governments to have than there used to be, because now they're still taking their shares. There's less. But I mean, clearly, I think I can say this, I think our chair would agree, that if there's anything we can do to help and there's any way for us to help, we'd be glad to help. And we stand ready to do that. So
Mary, yeah, we do, as Alan pointed out, hear this routinely all the time from all the stakeholders. So we're very aware. And our responses so far have been to have longer comment periods, right? So we, as you will hear soon coming up, we have a lot of due process documents actually coming out towards the end of the year. We haven't yet contemplated the comment period, but I would expect, especially because we have so many, they might be extra long. And it's trying to understand there are fewer people doing this work, give you more time to respond, longer effective periods, give you more time to deal with new standards. And on our agenda, we really have worked to set a pretty high bar a high bar. So I can put a high bar for us to undertake a project. If we're going to ask as auditors, you guys to audit, or as preparers for them to prepare new, change GAP in some way, add something to GAP, we want it to be a significant improvement if we're going to ask you to use those resources to do something different or new. And so as a result, we do have fewer things on our agenda now. And that's somewhat at least applying that high bar. It's not that we're stopping. If users, we think there's really that improvement, we'll start a project, and those are the ones you'll hear about soon. But so we are trying to be responsive in those ways. I think another thing that you touched on early on, the value, we already have some newer education initiatives geared towards, in particular, elected officials, but we think it will help everybody to talk about things like the value of accounting, or how to use financial reports, how to use the government-wide statements in more less technical terms, that sort of thing. So we hope to, as we work through those, we will certainly let you guys know and see how we could use them together and partner together to try to get that kind of education out, to maybe increase the knowledge of elected officials related to accounting and financial reporting, and hopefully then therefore improve and see more value.
Yeah, thank you for that, Joel. And I think, that lack of awareness and understanding ultimately results in a lack of funding directed at those areas, right? So, and again, when you see the report, you're going to see that kind of theme sprinkled throughout. So anyway, I look forward to, all of us working together to figure it out. But this report for us is an important step to at least get the issues out on the table. So
thank you for that, and thank you for undertaking that investigation. We look forward to the report too.
So Mary, can I ask, is that report going to report out sort of the findings of the survey, or will that report also have recommendations in there about potentially things that could be done about what you find?
yes, both. So that it'll be a fairly, at least, we haven't gotten it to our people that do all the graphics and everything like that, but at least what we're submitting to them has all of those details, lots of pie charts and graphs that show the different responses, and then the key themes that we heard, as well as recommendations.
Thank you, Mary, and thanks for the additional feedback. Any other questions? Thank you. So moving on to the next section of our agenda, we'd like to provide some feedback on a due process document that was recently issued regarding classification of non-financial assets, and I'll turn it over to Tim to lead our discussion with that.
Yeah, thanks, Tony. Obviously, we had the exposure draft, and we provided a response comment letter on that. And following the project at the last several meetings, we appreciate the board taking the time to, go through all the comments that were received, and we feel like we had our voice heard on the display of assets considered held for sale. And so really appreciate that. Aside from that, in our discussions yesterday, we don't really have a whole lot else on this item for you all, other than to ask if there's anything for us today. But just appreciate the opportunity to provide comment and to have our voice heard on some of those things.
Well, thank you for providing the comment letter. As always, we really appreciate the valuable feedback that we get from this group in your letters. As you did mention, perhaps at this point, the most significant change from the exposure draft was in response to one of the comments from this group's letter, which is pulling that held for sale out of the capital asset roll forward and just doing a disclosure of the ending balances separately. So we really appreciate you making that suggestion to us, and we think it's going to be a good one.
Thank you, Tim. Deborah, any other questions pertaining to that topic? So at this point, Joel, I'll hand it over to you to lead us through the recent GASB activity updates.
Sure. Thank you all for updates on things you're seeing in practice, and for your responses to the exposure draft. We are going to now, I will turn it, and turn to our project managers, our awesome project managers, to give you a little bit of an update on some of the projects we're working on, and get, either ability to answer questions or provide any comments you have so far. And the first one up is our project on going concern, uncertainty, and severe financial stress, which we just finished a pretty solid day plus of deliberations on. But Jalan, if you'll update the group, that would be great.
Of course, yes. Thanks, Joe. And also, I want to first thank my two fabulous task force members on this group, Tim and Jody, who has been extremely helpful in helping us work on some of the very difficult issues on the project. So a very brief recap of the history of the project. The pre-agenda research on going concern, uncertainty, severe financial stress was initiated back in 2015, 2016 as a response to the AICPA's request to study the inconsistency in practice when government applied the existing Statement 56 going concern guidance there. And then it took us almost 6 years to carry that pre-agenda research, where in December of 2021, the board has studied that result and decided there's room for improvement for the current going concern guidance. And it's also room for address an issue that's not currently addressed in the GASB literature, which is severe financial stress. And should the government make disclosures, and under what circumstances should they make that severe financial stress disclosure, and things like that. So that deliberation of the project started in July 2022, and the board decided to take a two-step approach to study the going concern uncertainty guidance for the enhancement part as the first part of the project. And then based on those, then the board started to deliberate on the second part of the project, severe financial stress, in May of last year. So like Joe said, we had a very robust deliberation all day yesterday and first part of this morning, just right before this meeting started. So I wanted to give you a summary of the major tentative decisions made since the last liaison meeting with this group. And the last liaison meeting was November 2022. So since then, as you see, we got to the point where we had concluded the going concern uncertainty part of the guidance that we had decided to carry out before we get to the disclosure for going concern uncertainty, to go out for user outreach, to study, to get feedback from the users, whether the proposed tentative items about those potential disclosure that would actually meet the essentiality requirement as defined in GASB's dual concept statement number 7. So that, so we took a pause from that. We decided to be efficient and do the user outreach for that part of potential disclosure along with the severe financial stress part of the disclosure. So we took a pause there last year, started working on, I think it's probably the more difficult part of this project. Jody and Tim, I see them smile because they've been through the process of figuring out some very difficult issues to find out how should we describe severe financial stress, which is a very new concept. And we went through several meetings last year. And by November last year, the board reached some tentative decisions about that. And then, right now for this meeting that ended, the board discussed the approaches to describe the concept within the severe financial stress. So first of all, I want to share with you the tentative board decision reached about a government when they should make that disclosure. So a government should make severe financial stress disclosures when it is experiencing financial difficulties at such a degree that is near or at the point of insolvency. And also, the insolvency is tentatively decided to be described as a circumstance in which a government generally is not paying its liabilities as they come due, or is unable to pay its liabilities as they come due. So you see there's first a description of that severe financial stress condition being near or at insolvency. And then the harder part is what do you mean by near insolvency? And that's what this board meeting, the topic we discussed with the board. So we don't have the tentative decision yet, but I'm happy to share that we reached very solid conclusion after very robust deliberation, that we have an approach, which also we got a lot of help from the task force member is approach to use some sort of a description to describe near insolvency, and in combination of a list of examples of indicators to help stakeholders to identify and assess whether they're near insolvency. So that's what we discussed. There was this list and then work on the descriptions and such. So those are, I would say, the big piece of what we have done since 2022 up to this point. So what's our next steps? Like I said, we had to taken a pause for the going concern uncertainty guidance and save that outreach to when we do the outreach for severe financial stress potential disclosure. And I'm happy to report this first quarter of this year, we have done that user outreach. So we went out to talk to a number of users in all different types. And, they're including credit analysts, including academia, including citizens, and including research organizations. So all type of user, we had interviews with them to ask them specific questions that help us collect that information about whether these information will have a meaningful effect to their analysis, and also whether we could identify from looking at these feedback to find out whether there is a depth or breadth of the users who would have used this information or would expect to use the information if the information were to provide it. So on both going concern uncertainty and on severe financial stress. We also carried out a survey to everyone we know, and we did a lot of campaign to advocate or advertise this survey for users to participate. And we received some solid responses and to find out, again, similar information, ask those questions so we can report back those information to the board. So the plan is for the July board meeting, we're going to report back to the board about these feedback we received and analyzed, and for the board to facilitate their discussion whether they believe each individual potential disclosure item for going concern uncertainty and for severe financial stress would meet that essentiality criteria in order for the board to finally decide and determine the tentative decision on the disclosure requirement on these two topics. And then the next step after that July meeting is for this project team that including Deborah and some other folks on the team to work on the preliminary review document. And that one will be discussed at the September meeting, the draft of preliminary review document, and then other things as analysis. And then the plan, according to the project plan, is for the board to look at the draft that time, and then also at November meeting, December meeting. If everything goes well, cross my fingers, then you will see a preliminary review document end of this year, beginning of next year, somewhere, first quarter. And then we start all the, as Joe alluded to earlier, this comment period. And then we also plan some public hearings and user forum and things like that, because ultimately this is a disclosure requirement. So we need participants, everybody's help for giving us the feedback on from preparer, auditor perspective, and also from the user perspective. So, and last, I want to emphasize this task force is so important to this project. We established the task force 2 years ago. We have 4 auditors, 6 preparers, and 7 users on our task force. So it's a very solid team. And like I said, Tim and Jody has been tremendous helpful for us, and they participated in pretty much all of those task force meetings. Even though their virtual meetings are long, sometimes goes over an hour, an hour and a half, and sometimes the discussion was so engaged and lively. I couldn't tell you how appreciated I'm always enjoying those task force discussion with folks from all our stakeholder groups. So we had 12 virtual meetings so far, and sometimes even before the paper was in the shape to share with the board, we got feedbacks and ideas and suggestions from task force. And then, of course, after the paper took shape and distributed, we talked to our task force again to get feedbacks and share with the board. So if you watch any of the recording for our board or live meeting, you will see we always share with the task force, with the board about task force feedback on anything we talk about during those meetings. So that's kind of the bigger picture of where we are, what we have done. So any questions, happy to answer.
Well, first, I'd just like to say thank you. Being involved in the task force, it's very clear the detailed process, very thoughtful that's going through on this complex issue. Looking at the diversity of governments that are out there, this is not an easy task to try to write something for. And so we really appreciate all the time and effort that's going into thinking through the different aspects from the preparer, the user, and the auditor standpoint for this disclosure. And we look forward to continuing to watch for the next steps and ultimately the preliminary views.
Thanks, Shalon and Jody. Any other questions on that one? Right. Next, we will move on to an update for our revenue and expense recognition project. Pam, if you will please update the group, that would be awesome.
Thank you. So as you all know, the board issued the preliminary views for revenue and expense recognition in June of 2020. And after spending some good time working through the categorization component of the model, the board has more recently been focused on the PV proposals that relate to recognition. And this work is really focused on what we call the anchored element hierarchy, which has been developed as kind of a methodology to assess when a government is entitled to a receivable in a revenue transaction or a payable in an payable and expense transaction. We call those receivables and payables the anchor in those transactions. And then the recognition methodology then works through what is the accompanying element to that receivable or payable. So for example, in a revenue transaction, the real anchor is determining when a receivable arises and then turn to what is the accompanying credit for that receivable. Is it a liability? Is it a deferred inflow of resources, or is it a revenue? And so that's kind of the process the board has been going through in redeliberating the recognition piece of the proposals. The board started these deliberations really by looking at the category B side of the PV. And that, of course, is the guidance that is existing primarily in Statement 33. So I wanted to kind of cover just a little bit kind of some of the overarching concepts and things that kind of relate to all of those types of thoughts. And the first one I want to kind of touch on is distinguishing between eligibility requirements and time requirements. We've talked about that a lot throughout these deliberations. And that's an area that, was identified in the PIR of Statement 33 as causing some confusion, some issues with stakeholders. And so by talking about those, there's a few things that kind of came out of that. And kind of at this point, before I go into that, I do want to say that when the board was in the working through the categorization proposals and applying the categorization methodology, they did arrive at a conclusion for grants that was different from that was proposed in the PV. Just as a reminder that in the PV, those eligibility-based grants were categorized as a category A, having a performance obligation. And so in the board's redeliberations, they've came to a different conclusion on grants, that they are transactions generally that do not have a performance obligation. So that's why the distinction between time requirements and eligibility requirements became, more important, especially related to those types of transactions. And so what the board has tentatively arrived at regarding eligibility requirements is that they're different from time requirements. And in Statement 33, in places of Statement 33, time requirements are described as a type of eligibility requirement. The board's arrived at place that those are two different ideas and two different concepts. And so one of those clarifications has resulted in kind of the renaming of eligibility requirements to be qualifying requirements. Paulina mentioned qualifying requirements a couple times earlier because she's thinking of them that way now. And so that's kind of an important piece that's changed, and we're hopeful that that will help in kind of really parting the waters between the idea of an eligibility requirement, now a qualifying requirement, and time requirements. And so what the board's tentatively decided of how to describe what is a qualifying requirement is that they are a condition imposed by external parties or law that are required to be met before the resource recipient is entitled to the resources. And that as a subgroup of qualifying requirements, there's qualifying costs, that, in other words, the governments must incur those costs before they're entitled to the resources from the provider, or there's other qualifying requirements, for example, an action by the government in order to be entitled to those resources, like maybe they need to get a match for their grant. So that distinction between time requirements and qualifying requirements is kind of an important piece that the board's worked through to kind of clarify, hopefully, some of the confusion maybe that's resulted over time between those two ideas. On the other side of that discussion is time requirements. And so what are those? And those have kind of been pretty prevalent in many of the transactions that the board's been looking at over the past few months. And so the way I kind of like to describe it is what are they and what are they not? And so time requirements are, first of all, a recognition attribute that informs the recognition of a deferred inflow of resources. And that's kind of all they are. They're not anything more than that. And so it's kind of simplified, I think, it in a lot of ways. What are they? They're externally stipulated by the resource provider, or explicitly, stipulated. So they're not something that's implicit in anything. They need to be explicitly stipulated. They're temporary limitations that permit the use of resources beginning at a certain point in time. They are not contract terms. They are not specifically grant performance periods, are not a time requirement. They're not a payment schedule or how collections are timed, and they're not permanent constraints, which is a change from existing guidance specifically related to endowments. And then the last thing that's kind of an overarching concept that's also, I think, caused some confusion in existing guidance is purpose restrictions. And, how do you tell the difference between a purpose restriction and an eligibility requirement? And I think we've tried to really work on clarifying that purpose restrictions do not inform recognition. And so they're something that is, going to be reflected in your fund balance or net position as a restriction. They're not something that's going to decide whether you're entitled to a resource or whether you have a revenue. And so those are kind of some of the overarching things that the board has come to in their deliberations about all of these Category B type transactions that they've gone through. And so, again, how we've looked at these transactions, we started is by utilizing this recognition methodology that I described with the anchoring element and the accompanying element. And so we've gone through a lot of transactions with the board. We went through many of them just earlier this week. I just wanted to highlight a couple of those transactions because they're ones that resulted in what would be a change from existing guidance or will result in a change. The first one I wanted to mention was property taxes. In existing guidance, there's language about liens, levies, assessments, and I think that's resulted in governments potentially arriving at different conclusion as to when a receivable arises for a property tax. And so the board has similar to the PV. I don't think this redeliberation has resulted in a change from that, but they really wanting to remove the language about levies and liens because it can be kind of lead people to different places in terms of their recognition of a property tax. And we have gotten feedback that that change that was proposed in the PV for some governments will or may result in a change in when they recognize a receivable. Another one I wanted to mention was pledges. And I already did actually that basically permanent endowments, currently recognize a time requirement as to when the resources are not being spent, kind of a little bit of an odd use of a time requirement. What the PV proposed and the board has affirmed in their redeliberations is that a pledge, whether it's permanent or a term endowment, are still recognized as revenue when the binding arrangement arises that's verifiable. And so instead of recognizing a deferral in those cases for permanent endowments. And then finally, the one I wanted to highlight was general aid. And we discussed that just earlier this week for quite a while. And so what the board has tentatively decided is that the receivable and payable in a general aid type of transaction arises when the payment is due. And that when the payment is due is to be based on normal practice or convention. When the payment is due and there's an appropriation and the fiscal year has begun, and that there's a presumption that the government intends to pay it unless the government's been informed or becomes aware that it isn't going to be paid. And so that's kind of where they've arrived at. It's different, of course, from the guidance in Statement 33, in which recognition happens on the first day of the fiscal period. The board's worked through a lot of other transactions other than those three, regulatory and punitive fees, derived revenue transactions, special assessments, impact fees, a lot of other transactions they've worked through as well. We're hoping that we will be wrapping up Category B, the redeliberations for Category B transactions next month, with fingers crossed, and hope to get into Category A, which is, of course, performance obligation type transactions later this summer.
Thanks, Pam. Given that there's a long runway here, it's hard to make any specific comments here because we haven't had an opportunity as a group, but just some high level thoughts as we've been observing the process. And from an overall perspective, we just want to say thank you for all the time and effort that you are giving to this. We recognize the amount of time that staff has invested in outreach and research and really trying to think this through, all the time the board is dedicated to the deliberation. And we're just seeing a lot of meaningful progress on this. And I'm starting to see the end of the light at the end of the tunnel here as you're really getting farther along, and it's really exciting to see. And when you look at it, there is a need today for this guidance. And you look at, first of all, Category A transactions, there's not much out there to help the preparers in that. And I think having a comprehensive framework is going to help significantly. And then on the Category B, we're just thrilled that the grants and the voluntary non-exchange came over to B. They're very thrilled. But we're also thrilled that you're taking the time to really think about this and the terminology that you're using, the qualifying requirements, the time requirements, because as you look at 33 today, it's probably one of the most difficult standards to interpret. When you're new to it, it's a little bit shocking. It takes a lot. There's a lot of Q&As. And at least the feeling I'm getting here is this guidance is hopefully going to be easier to apply and clear to the users as well as result in less Q&As that are necessary to help interpret what's in the standard. So yeah, we think that's great, and thank you for all that effort. I don't have any other comments.
Thanks, Pam and Jeff. And you almost said what I was going to say, Jeff, but I'll say it too. This project is vast. It touches a lot of transactions that governments have. So it will be big, but while all our standards, we work to make sure that they're understandable, easy to work with, et cetera. This one in particular, we are really spending a lot of time hammering the principles to make sure that they are as simple as they can be to get to the place we want them to be, and that we're describing them in a way that will be as easy to understand as possible. So we do that with all projects, but this one in particular, because it's so vast and touches so much stuff, that's really important to us. So it's good that you are seeing that seems to be coming out. We still have work to do, obviously, but I appreciate you saying that, because that's very important to us, in particular on this project. All right, thanks again. We will move to the next project, which is our infrastructure asset project. Scott, if you'll walk us through progress on that one, that would be great.
Okay, thank you. This project, similar to the going concern project, is still in the stage that's leading to a preliminary views document. The board has currently deliberated all the topics. We've still got some decisions to make. They similar to the going concern project, they've talked about disclosures that they believe would meet the conceptual definition, but staff has just been wrapping up some outreach we've done to users as to whether those Con 7 requirements are met for the disclosures the board's thought about. And that's the next stage of the project next month, to come back to the board with those findings for the board to make those decisions. But the board has basically deliberated all the other topics related to recognition and measurement and things of that nature at this stage. Earlier this week, they looked at draft sections of the preliminary views related to the definition of infrastructure assets, recognition and measurement of infrastructure assets. To let you know, for the board to date, is basically in relation to recognition and measurement carried forward the current requirements in statement 34. I believe, from staff outlook, when this project was added to the pre-agenda research, there was some hope that since statement 34 had been issued, I should say, not implemented, but issued, that practice had developed some standardization and things like that. As far as condition assessments and those types of things of information related to infrastructure assets that are reported using the modified approach. But what we found was, no, that really isn't the case among any of the different types of infrastructure assets. There's not a lot of standardization and things of that nature. And so, when discussing the recognition and measurement requirements, the board as I said, carried forward their current requirements. They believe that, the historical costs using net of accumulated depreciation appropriately allocates costs to periods, a fundamental concept of governmental financial reporting. But they also wanted to allow the modified approach to be used, because in the pre-agenda research, users that type of information in the RSI was found to be the most valuable of any of the information related to capital assets, is the condition, things of that nature, how much the government expected to spend on maintenance and things of that nature. So as far as recognition measurement, their board decided to try to clarify or highlight a couple issues, I should say. One is that because infrastructure assets are long-lived assets, that estimated useful lives need to be reevaluated periodically. And, you think of a road, the surface maybe is 10 years, but the various layers underneath are 20, 30, 40 years and things like that. And that, the board's not looking for the estimated useful lives basically to be set it and forget it, that you need to take into account that you're in a state that's hotter, or for whatever reason, the roads don't last as long or last longer than other places. The other issue related to capitalizing and using historical cost net of accumulated depreciation that the board talked about and wanted to highlight is that, especially for infrastructure assets, there are a lot of times various components to the infrastructure asset, and some of those components may have different estimated useful lives, and that if there are significant amounts related to components that have a different estimated useful life than the, for lack of a better term, the whole infrastructure asset, that those components should be depreciated over that different estimated useful life. And that is something that there's Q&As in the current literature. The board just wants to highlight that and bring that into level 8 gap. As far as some of the disclosures the board initially talked about that we were getting outreach on, initially, I would say the key one that the board talked about was disclosure related to maintenance expense. In an attempt to try to give some information, especially for those governments that use historical cost net of accumulated depreciation to record their infrastructure assets, amounts of ongoing expenditures to keep those assets in the condition that is necessary, that those estimated useful lives would be appropriate. I guess the final thing I talked about, and that I'll talk about, and it's kind of related to that, as well as the board did discuss deferred maintenance, as that came up quite a bit in the pre-agenda research. The board determined that deferred maintenance didn't meet the conceptual definition of a liability. And so several of the things I just talked about earlier, though, kind of drove some of the board's decisions to try to provide and make the information related to those assets, especially those related to assets or infrastructure assets reported using historical cost netted depreciation, to give some of that information that may be similar to or a component of what is necessary to calculate deferred maintenance, such as I said, giving maintenance expense that the user could then, knowing the infrastructure assets of that government, come up with their own scale or judgment as to what was necessary to keep that level of infrastructure assets maintained. Turn over to you, Tracy.
Thank you, Scott, and thanks to the board and the staff for the diligence on this statement, or preliminary statement. So we really did look forward to the preliminary views. We know those are coming out, and in our discussions yesterday, I took a very unscientific informal poll of all of our clients and talked about modified approach is really what we were talking about. And there's a handful of us that know of clients that actually are using modified approach. But the ones that are using it are happy that they're using it. And I think we'll be happy if that stays in RSI, but we'll see where that goes. But we look forward to seeing the preliminary views, and we'll certainly be able to have comments or questions when that comes out. So thank you.
Thanks, Scott. And Tracy, any other comments or questions on the infrastructure project? So I think you've heard now from both the going concern severe financial stress project and on the infrastructure project, we are operationalized concept statement 7, and it is adding to the work we're doing on potential disclosures to really have a lot of good information for the board to make a determination that that item of information is essential. And it's adding a lot of work, and we really appreciate the users interacting with us to provide us with that information, and we're getting them engaged, and we are getting that information. It is a lot of extra work, but we think that that's important, right? If we're going to ask preparers to now add something to the already voluminous disclosures and you guys to audit that already voluminous disclosure item, we want it to really be meaningful. So it is work, but we are doing it on every project and every potential thing for disclosure that we're considering. And so you've heard that now in both of our projects. So With that, we will move to another project that also includes disclosure, and that is subsequent events. And Joe, if you'll start us off and tell the group what we've been working on that project, we'd appreciate it.
All right, thank you. So I would start out by noting that the AICPA's financial reporting guidance for subsequent events in what would now be considered the pre-clarity AU 560 subsequent events back from 1972, that was essentially incorporated as is into Statement 56 in 2009. And so as we got into this, and after about a year of pre-agenda research, the board approved a project prospectus last August, and we began deliberations with the board back in October. And the objective of this project is to improve accounting and financial reporting for subsequent events. And we're going to be re-examining existing requirements about subsequent events, Statement 56, and addressing issues such as confusion about or challenges associated with applying the existing standards, inconsistency in practice in the information provided about subsequent events, and the usefulness of the information provided about subsequent events. So the project team wanted to highlight some of the tentative decisions so far to date in this project. And the first one would be the time period for evaluating subsequent events. So currently, Statement 56 requires that you would evaluate subsequent events to the date the financial statements are issued. In re-examining that, the board considered, options and tentatively decided to change that to be that subsequent events will be evaluated through the date the financial statements are available to be issued. And that also that that day would be defined substantively similar to how the FASB uses that term. So that would be that the financial statements are complete and compliant with GAAP, the necessary approvals have been obtained, stuff like that. And so using that available to be issued date, the board believes it'll alleviate some potential concerns regarding a possible gap between the auditor's report date and the actual issuance of the financial statements, and then also provide some clarity and consistency in the application of new guidance. Two additional items would be descriptions used when we talk about subsequent events. We have two types. We have non-recognized and we have recognized. When we talk about recognized, I'd say generally the concept is the same as what's in Statement 56, in that we're talking about events that occur after the financial statement date that inform estimates as of the financial statement date and should be incorporated into the amounts reported as the financial statement date, but has some refinement in the language to make it consistent with the guidance in Statement 100 for error corrections, because that already requires consideration of facts considered through the issuance date. For non-recognized events, Statement 56 is pretty broad in describing those, essentially as items that are of such nature as to be essential to a user's understanding of the financial statements. And it does include some examples of non-recognized events. The board tentatively decided that first, certain events and transactions should be explicitly identified as non-recognized events, and that also other events or transactions are of such a nature to be essential to a user's analysis for making decisions or assessing accountability would also be disclosed. And when we talk about those explicitly identified events or transactions, those would be a debt-related transaction, a government combination or disposal of a government operation, a change to the legally separate entities that comprise a financial reporting entity, or a change in the applied tax rates. And the approach is, again, somewhat similar to what we have in Statement 56, a little bit of wording change for Concept Statement 7 when we talk about essentiality. But some of the intent here is that those events that are explicitly identified should be disclosed in all circumstances, and that they're not just examples. Also, the requirements of disclosures of subsequent events. Statement 56 is not specific in this regard. Anecdotally, there is some inconsistency in practice which could be improved with a little bit more guidance here. And so the board has tentatively decided that no disclosures of subsequent events should include both description of the non-recognized event and then also an estimate of the effect of that non-recognized event on the basic financials, or the reason why an estimate cannot be made. So just kind of getting that consistency there. And then the last time I would bring up today would be reissuance. So paragraph 14 of Statement 56 provides specific guidance for evaluating subsequent events when financial statements are determined to be reissued. In revisiting those requirements, the board tentatively decided It would be preferable to rely on that available to be issued date without providing additional specific guidance for when financial statements are reissued. The board believes this approach is a little more clear because it eliminates the potential for various interpretations associated with the term reissued, and that relying on that available to be issued date would incorporate circumstances in which financial statements are revised, because in those cases, there would be a new available to be issued date when those financials are complete and compliant with GAAP, et cetera. So those are some of the key changes we've talked about in this project. I would say the path forward, expect an exposure draft later this fall. I would say probably November 2024, and then in issuance anticipated currently December 2025. But I would note we're going to be talking with the board at the July 2024 board meeting about effective date and transition date. So I would say at this point, stay tuned. Right? And any questions?
Thank you, Joe. Appreciate that, and really appreciate the board taking on this project. I think, as you mentioned in the pre-agenda research, it sounded like there was some diversity in practice on sub-event disclosures. So I think it's important for the board to address that and come up with guidance that leads to more consistency in financial reporting. Because you're in initial deliberations, we as a panel have not discussed our views on any of the conclusions or the tentative conclusions that you've reached at this point, but we certainly look forward to doing that. And of course, we'll be issuing a comment letter. I also just wanted to say that I know in a lot of the board discussion that has happened, that you've mentioned or talked about the auditor perspective in addressing subsequent events. And as a panel of mostly auditors, we very much appreciate that. So thank you very much.
Thanks, Joe. Thanks, Chris. And we have. You were correct. All right, that takes us to our next topic, which isn't a standard setting project topic, but when we issue standards, we don't just issue them, set them, and forget them. We actually have a post-implementation review process that is injected as part of our overall standard setting process. And we wanted to give you guys an update of the activities that are going on in our post-implementation reviews. And I think we're starting with Tammy, probably here, yes.
Thank you, Joel. So what we'd like to do today is to provide you with an update of where we are on post-implementation review projects, and more specifically, the pension PIR report, which we just recently completed and presented to the trustees last week in DC. So if you're looking for that report, it'll be hot off the press next week. So you'll have an opportunity to look at that fantastic 53-page document in detail. So today, in the few minutes that we have, I thought we would hit, kind of some of the big picture kind of pieces associated with PIR and the pension PIR specifically. But I do want to highlight at the outset the significance of this particular PIR project. And there are two reasons that this particular PIR project is significant, I think. One of those is that this is the first PIR report to come out of a new process that was adopted by the trustees in 2020. And that is true for both organizations, the GASB and the FASB. So the FASB is working on one, but we're sort of out front. They'll release one later this year on topic 606. And so we're blazing new trails in that regard. And then, as you probably know, these PIR projects are done on projects that are more significant. They're bigger in magnitude. But if we could have picked the biggest one we could have done, it's clearly the pension standards, 67 and 68. And this is the place where I'll give a shout out to Jalon, who led this project and blazed the trail in a path of uncertainty and did a great job with it. And also Daniel Pollock, who did a great work on this project, who's in the room. So there are three sort of pieces here that I'd like to cover. And the first is, what do we mean by PIR? Because we want to be sure that we're clear on what we're accomplishing here. But the PIR process is effectively a quality control mechanism. As Joel said, we don't just set standards and forget about them. And so what we do in PIR is to evaluate, the effectiveness of the standards, evaluate cost and that sort of thing. And so that's an important piece of our standard setting process. And when the FAF returned that responsibility, embedded it back in the standard setting process, I think that means good things for how nimble we can be in responding to issues related to standards as they're issued and as they're implemented.
So there are three main objectives associated with PIR, and we'll talk about the results of the pension PIR specifically at the end. But those three objectives are to determine whether the statements, the standards are meeting their stated purpose. Number one. Number two, to determine whether the cost and the benefits are as the board contemplated and stakeholders expected. And then the third of those is the objective that is, do we recommend any sort of changes to the standard setting process? And I want to be sure that we differentiate that from recommending specific standard setting items. This is more about, was there anything that was part of the process leading up to the issuance of Statement 67 and 68, where we noticed things that might be applicable to changes in process, kind of more broadly speaking. And so I will give a little plug here. Alan did a podcast that will be released shortly. If you want more information about what PIR is and isn't, you'll have the opportunity to hear that, I think, in the near future. So that's sort of what PIR is and what it isn't. It happens in two stages, really. It happens in the post-implementation, post-issuance monitoring phase, where you can think about that like the lifting of the barn, making sure that everything is in place for the standards to be implemented effectively. And then we move into the post-effective date evaluation period. And those two stages, I do want to highlight that the work that we do, if you think about post-issuance monitoring, and things, the most common thing we do in that stage that we do for all of our projects is technical inquiries. And I know a lot of you take advantage of that, and we love interacting with you through those technical inquiries. And we do that for all of our projects, whether they're subject to a formal process or not. And so that TI process and a lot of the other educational materials that we do for every project. And that process involves people who are close to the development of the standard because they're the ones who have the expertise. And I want to differentiate that to the phase when we move into the post-effective date evaluation, when that's really an evaluation of the process that really does call for a little bit more objectivity. And so that's the reason that you would see, for example, Jalon leading the pension PIR report and not Michelle Shirkowski, who authored the statements. And so that's the way that we sort of think about the objectivity. That doesn't mean that we don't lean on the expertise of the people in-house who have worked directly on that project, but it is important if we're going to do this process that we do it in a way that conveys credibility and objectivity. So those are our stages, and we've finished writing the report. I want to talk to you a little bit about the methods that go into it before we talk about what the results of the pension PIR were. And I come from an academic background, and so I'm going to use a word that we use a lot in the academic community that makes my heart go pitter-pat, and it's called triangulation, and that means coming at things from multiple methods so that you can use all of the methods to get to the results that you need. And so we use 4 different methods to get at the results for the pension PIR and any of the 4 remaining PIR projects that are in place or in progress and coming along the path. Those 4 methods that we use include roundtables, which many of you participate in, and we're grateful for that. That's a fantastic way for us to hear from stakeholders of all types. And in the pension PIR review that we did, 5 stakeholder types were represented in 10 roundtables. And I will point out that in addition to the objectivity piece of ensuring that we have staff working on the project who were independent from the initial staff who worked on the standards. We also try to make sure that the people who we get in the room for those roundtables represent a diverse set of views. Like, we want to hear from different people, and we intentionally cultivate and curate those participant lists to include people who have differing views, perhaps, like, I don't know, maybe on discount rate, for example, and you'll see that in the report. You include people who have different views on that. So even that process, the way that we set it up, everything's intentional about who's in the room, the way that we do it, to ensure that all the voices are heard in that process. So that's a fantastic way, I think, that we go about ensuring that we meet those, that we can answer those 3 questions that are the objectives of PIR. The second of the 4 methods that we use are surveys, and we also appreciate your participation in those. We do the surveys kind of in 2 batches. And so there's one piece of it where we look at the cost of implementation. So there are cost surveys that we're trying to do close to the implementation date so people remember what those costs are and don't have to dig too far to get them. So there's some things in the process we're trying to do to ensure that we get good information in that process. And then in the case of pension PIR, we sent out surveys to 5 different stakeholder groups and got responses and evaluated from those perspectives the 3 different objectives. So surveys are sort of the second way that we think about doing PIR. The third way that we think about PIR through methods is through the use of archival data. And I don't know any way around in PIR of saying that we did a good PIR without actually looking at some financial statements. And it's about looking to see what's there. Is it what we expect based on what's the provisions of the standards? And also, are there, making sure there aren't things there that we wouldn't expect to see. Archival data obviously has some limitations associated with it. We don't have the benefit like you all do as auditors to know whether the information is complete and accurate. But we can look for things that would suggest exceptions or things that suggest learning in the process, that prepare governments are figuring it out and they're coming along in the process. So archival data is the third sort of cornerstone of PIR. And then the fourth one is a review and synthesis of any of the academic literature that we can bring to bear on the particular PIR that we're working on. In the case of the pension PIR, we reviewed a lot of different articles, abstracts and that sort of thing, but we narrowed it down to a set of about 38 articles that ended up, some of those cited in the PIR report that helped us determine whether those objectives of PIR we met those objectives of PIR in evaluating the standards. So those are the 4 things that we do associated with any PIR effort that we take and we bring in and then sort of triangulate it, see what we're hearing from different perspectives and how that sort of shakes out. In the case of pension PIR, so this is where sort of the punchline is with respect to the 3 objectives. The first objective, the staff team concluded that the standards had met their stated purpose. And we did hear from a lot of stakeholders on all the dimensions. As you know, those statements include provisions across everything you could possibly do in standard setting, recognition, measurement, disclosure. And there were positive things that we heard from users about all of those and the decision usefulness of that information. And so we concluded that objective 1, and it had 5 subparts, but that objective 1 and its 5 subparts were in fact met. The second objective, dealing with cost, I think the board anticipated in the development of Statement 67 and 68 that the costs would be significant, and they were, but so too were the benefits. And so the PIR process is really more about looking at whether those costs and the benefits were consistent with what the board contemplated, what stakeholders expected, and our team concluded that they were. The third and final objective associated with PIR is whether we would recommend any changes or made any recommendations for changes to the standard setting process more generally. And we didn't identify anything, we did not identify anything that suggested that there needed to be a change in the standard setting processes. As part of the PIR process, we go back and look at everything from the time that the projects like Statement 67 and 68, when they first came onto the board's agenda in 2008, all the way to the issuance in 2012, looked at the due process document, read a lot of basis for conclusions, spent a lot of time in all of that material, and concluded that the process was pretty robust. And I think a lot of you probably could speak to that as well, that the process was pretty deliberative. And so we don't have any changes that we would recommend to the standard setting process. Although I will say, and you will see it in the report when it's released next week, staff did note 2 things, I think, of interest. Not necessarily changes to the standard setting process, but just things that we wanted to highlight. And one of those, you heard from Joel earlier about this idea of Concept Statement 7 and what we're doing in our GCU SFS project and in our infrastructure project. There has been a conversation and the board has discussed a preliminary plan to think about the Concept Statement 7 essentiality provision, and could we look back at existing standards and the disclosures and look at those for purposes of whether it would meet the threshold of essentiality. And we basically disclaim that in the report and say we did not do that as part of pension PIR, but that is something that we are looking at doing. So we highlighted that in the report. And the other thing that we noted at the end of the report is that this was our first time through. As I mentioned, this report is significant in that it's the first one under the new process that the FAF adopted in 2020. And so because it was the first time through, we learned things in the process. And so I will say we are definitely listening to people who want to talk to us about our processes. We are comfortable with the conclusions that we reach related to those three main objectives of PIR. But we also know that there's always room to kind of tinker and make the process more efficient and cultivate voices in the process and improve our process for conducting PIR since it is now embedded fully in the standard setting process. So I'll stop there and we'll take questions.
Tammy, thank you so much for providing that status update. As a group of primarily auditors, I can tell you that monitoring in any form or fashion is very near and dear to our hearts. So thank you for walking us through the objectives and the methods that you're using. It sounds like a wonderful process and a time-consuming process. So thank you for your efforts. And we have all jotted a to-do to read the report next week. So thank you very much.
Thanks, Tammy. Marla, anybody else have any questions or? Tammy did mention the podcast, so another shout out to the GASB podcast. Is called Bridging the Gap with 2 A's in the gap. It's available on Apple, Spotify, wherever you get your podcasts.
Ring the call.
Please, please subscribe, rate and review 5 stars. We've got a few episodes, but we do have a 2-part series of podcasts coming up on PIR. The first one is Alan talking about the process, which Tammy just gave you a shorter version of. Alan's description is a little longer. And then we will have Tammy doing a results of the pension PIR podcast as a second episode, because we want them to be 10 to 15 minutes at the most. They're plain language. We're trying not to get too technical, but I encourage you to subscribe. With that, we wanted to go to our taxonomy work, another item that isn't a technical accounting standard setting project, but this is work that we view as very important for us in achieving our mission in the future, right? Of thinking about how technology is changing the way users of financial information consume that information. And as that is evolving, something like a financial statement taxonomy, or maybe specifically a financial statement taxonomy, was important for us to work on rather than somebody else doing something like that. And so we have started work on it. Now, the Financial Data Transparency Act kind of comes in the middle of us starting work on that. And so that does interplay a little bit into what we're doing. But Paulina, if you don't mind updating the group on our taxonomy work, that would be awesome.
Thank you, Joel. So as you may be aware, I think it's a monitoring activity. It has been on a technical agenda, probably more than 10 years. I mean, this is not new or something the guys we woke up one day and went, oh, we're going to start thinking about electronic reporting. It has been since Ken Sherman was worried about how to make PDFs jump around. Okay. It was fun. He thought electronic reporting was PDFs, and I loved him for that. So it's long predates me, the FTTA, or anything. I think when Joel arrived, there was a very renewed effort to look at it even broader than what we were just monitoring, and actually start getting engaged on the development of a taxonomy on itself. For a very long time, we have considered how to approach this. The team has grown in number quite a bit, and trying to work through the technology challenges that are out there. So obviously, when you think, anybody who hears the word taxonomy goes straight to XBRL. Well, there are other options, and we've been trying to explore other options, and we're trying to think about how those other options can work. We had to start somewhere, and so while our technology focus is intended to remain agnostic and continue open to any taxonomy, we have started the work through XBRL because we felt it was the quickest way to get us somewhere. So For the last few months, we spent an awful lot of time going through the provisions of Statement 34, reporting entity, reporting model, and just, it's actually funny. You think you know all these things, but until you start writing them down and inventorying them and checklist them through a process, it's a very interesting effort and an approach. Especially think about inventorying all the no disclosure requirements, not the ones you do voluntarily. And so, and then you have to add practice. And so it's a lot of fun complexity stuff. And so we had dedicated an awful lot of time and effort putting together that type of thing in Excel spreadsheet. So at the beginning was very crude and basic. We hire a taxonomy manager. Mijo is sitting right there. And so with her arrival, then we had the opportunity to start putting all these things in a syntax that was technology based, and the ability to start looking at, did this hold, does that hold? How does the reporting entity requirements with the financial reporting entity align, and how the structure of the data needs to line up? We have made a good progress. We are in the process of identifying, we have gone through a process of setting a scope. We are starting working with basic requirements in RSI. We know and acknowledge that there is such a thing as SI, and we do plan to get there one day, but we had to start somewhere. And so we have stood up most of the schedules, and we are now in a phase where the team is moving towards considerations, thinking about line items. Again, it seems very straightforward when you're putting it in a PDF. You know what your headers and line items and columns are, but until you write them out in a technical spec, is a whole different ballgame. Because you need to understand that the technical specs can meet the definition of the city of ABC. It needs to meet any governmental entity. And then the way we think about it is an accordion. So you have to expand it to meet anything optionality that you put, or compress it, or then pivot into classified and classified balance sheets and sort of things. And so it's really fun to write the specs for anything, not for a government, but for anything. So I think we're in a place where we feel very comfortable that our infrastructure underneath is there. And we're now moving forward a process of parsing PDFs to get line items and get commonality and start developing this, which opens a very interesting door in conversation with the board, which is we're looking at practice, right? Because standards do minimum requirements, and the minimum requirements give you the rows and columns, but that's it. But it doesn't tell you how to deal with the line items. It's a little bit more on the practice side. And so starting to try to think about how we want to approach interjecting all those line items with a level of sufficiency that when we publish something, it can encompass and be able to help a good amount of governments, and then provide the variability and the flexibility that the things that we didn't come up with, then the preparer can put on. So we're working through all that. Then we would be going to a phase where we're going to be the part that accountants love, writing out the descriptions and the definitions of those line items. I think those are the pieces where most of the accounting people in the profession are going to be very geared towards paying attention and focus, as opposed to all this data structure that you're talking about. And so hopefully when we get there will be a lot more interesting conversations to come up with. But for us, the data component has been an extremely interesting exercise of intellectual activity, because like I said, you can't put one government. You need to make it up and down scalable and up and down scalable on the other side. So it's been a very fun journey. It's been really interesting. We hope to continue to move forward, and we'll see in the next 6 to 8 months, we hope to start being able to see line item philosophical things that we need to think through. One of the really, really things that would hit you a little hard is how to deal with the different bases of accounting. So, and there's multiple taxonomies out in the world. And yes, we have studied all of them. We have looked at the IFRS taxonomy, the FASB taxonomy, at the XBRL US taxonomy. We looked at all these things, but really nobody has this problem. So budgetary basis, accrual, modified accrual, what do you do with that? So we have a very unique and interesting circumstance to model from that perspective. We're looking at options. We're thinking about how we can make them react. And the very important issue, how would the user respond to that data? And how would the user respond to the structure of the data? So again, a lot of very fun conversations, a lot of intellectual involvement. I don't know how familiar you are with the debates in the FDTA. The other very active topic that, while we have been very focused on the taxonomy development, we oftentimes tend to, our thinking spend potentially too much time on legal entity identifier issues is a very prevalent topic, as you're familiar with those issues. Legal entity identifier is a very hot topic with FTTA. How do we do? What do we do? And then can somebody reconcile with reporting entity? And we're not getting a lot of sense of clarity. And if we come up with a financial reporting entity taxonomy and the legal entity identifier don't align, do we not have a problem? We should have a problem. And so just trying to think through how could we at least help the conversation on how those pieces come together. That's basically the work we're doing. As I said, is basically monitoring activity. It's a fairly large team that we're working on. And hopefully at some point we'll be able to share what it looks like and start working through a little bit more of information communication.
Wow, that was a lot. We had about a 5-minute conversation on it as well.
I can talk to you for 3 hours.
And yeah, I think you've really hit on a lot of the hurdles that we foresee, as well as, and one of the ones that may be important to the client is, who's going to carry the cost. So, that's potentially a significant issue, and what level of government is going to be able to handle the transmission of all that data in the format that you end up settling on. So I think those are some of the challenges in addition to the things that you obviously talked about that could potentially be out there. We realize, or we certainly discussed the fact that the market probably wants this data available to them for utilization. So that's important. But I think overall, we look forward to see where you head with the project.
Thank you, Paulina and Bill. Any other questions or comments on that?
Joel? I
Yes,
thought I'd
Jeff?
just mention one thing because I come from the user perspective, right? So there's been some degree of discussion among users about this, and I think their starting off point, which I think is important, is we don't want to lose information in the transition, right? So they're not able to think much beyond that. Like, what is this supposed to look like? How is it supposed to be done? Their main concern is I don't lose in this translation. And so when we're thinking about that, I think that's you guys to be thinking about like how users are thinking about this, and because they're petrified that there's going to be some half measure done, and then they're going to lose that PDF, and then they're only going to have half the information they had before. And that's going to be a negative for them. So how that gets done in this process remains to be seen. But that's the flip side consideration to the cost consideration, which is a real one that the governments have, but the users have that concern.
And I guess the other additional item that I didn't mention, but we certainly talked about was, okay, well, who's going to be responsible for validation, right, of the information? So, and that's kind of alluding to what you're making the point, right? So you get a nice PDF of a big document that you can peruse, and you've seen many of them, and so you can garner the information that you need. But then if it's going to go into electronic format, is there going to be some sort of check process on that?
The users I've talked to are amazed, right? That the XBRL stuff, there's no auditor involvement in that, right? So in the government side, 'cause they're just not familiar with it, they're like, what? So they're still, I think, trying to process what does that mean and how do I think about this information?
Thanks, Jeff. From our perspective right now, this is a voluntary taxonomy, whatever we call it, ultimately, it would be voluntary. To the extent it becomes mandatory as a result of like FDTA is up to the Securities and Exchange Commission, in particular, the Office of Municipal Securities. We are updating them routinely on the work we're doing on the taxonomy. What they ultimately do with that or anything related to FDTA is up to them, which could include or not include verification, et cetera. Although as noted on the FASB side, which the SEC also mandates, they didn't require any kind of validation requirement. But it is something that certainly, as you have any questions about FDTA, to the extent we can help, we're always available. We are certainly in constant communication with the SEC and trying to monitor what's going on and interact with them. So we are keeping pretty a pulse on what's going on as best we can.
And Joel, just real quick, we want to show our appreciation that we sigh of relief when we knew the GASB was being proactive, being involved with this process and the monitoring, and rather than potentially reactive when it's too late. So again, extend our appreciation for that.
Thanks, Tony. That's it. I don't know if you want to have any closing comments, Tony, or
just to reiterate our appreciation for being here. And we've mentioned a lot of preliminary views and exposure drafts we're expecting later in the year. But as always, we always are open to direct outreach at any time to the panel as a whole or individual members on individual topics on any of the projects or potential projects or any issues. So please continue that, because we welcome that and are appreciative of that effort.
Thanks. I did want to highlight a couple other things real quick. One, we obviously have some emphasis on technology, right? With the taxonomy. The podcast isn't necessarily technology, but new ways of doing things. But you've probably already heard about our new improved GARS. It's been around for a year now. Yeah, a little over a year. Wow, time flies. But that was a significant investment that we made, and Michelle in particular led that effort. But we get a lot of good feedback. So if you haven't tried doing improved GARS, it's out and it's great. We have a new website, Michelle is also instrumental in, that we invested in, that we launched earlier this year. So hopefully you're familiar with that. But new ways to interact with us and trying to improve our use in technology. You may not necessarily see it, but we're going to start investing more in trying to use technology more in our research and improve the efficiency and effectiveness of our research activities. So we are doing things like that. And then finally, as it relates to kind of constant updating, we appreciate and heard the practice issues you raised earlier. We didn't issue an implementation guide update for 2024, but we are beginning the process, and I think I can say expect to probably issue one for 2025, which means we are starting the process now of accumulating what questions might be in that. And so we heard some of yours from earlier, but to the extent over the next, in particular, several months, but anytime you have things that might be good for such an update, please send them to us, because we're in the process of looking at that now. Otherwise, thank you so much for being here. We really appreciate all your feedback and willingness to participate with us at meetings like this, on task forces and comment letters and the day-to-day communication. So thank you.
And Joel,
Appreciate
one
being
thing
here.
we didn't mention is the 40th anniversary of GASB. So congratulations on that, right?
We're
And
very
thank you.
excited.
Thank you for this. This very nice. So, thank you.
We're very excited. Yeah, I mean, the actual anniversary is really soon. Of the first meeting, I think.
I think it was June 14th, if I'm not mistaken. It's June
Really?
14th.
It's interesting. Our Governmental Audit Quality Center is celebrating its 20th anniversary this year. So
Congratulations.
you're
That's
around 20
great.
extra years, but
She's called us
We're
old,
just
by the
older.
way. She's
Yeah.
called us old.
Older and wise. All right. Well, I think that then concludes the liaison meeting. Thanks again to everybody. Until next time.